and welcome into Making Sense. You know, you go to a theme park, you go to this great big roller coaster, and they put warning signs before you get on, and they talk about heart conditions, or maybe if you're faint of heart. Well, guess what? The same thing can happen in the stock market. If you're faint of heart, you may want to not get on that ride. But once you're on, hang on. And today we have with us Brandt McDonald. Barranco, Hagen Wealth Management. Glad to have you back again. You're a regular here, so hopefully our viewers, I don't have to get too much in your background, but you've been in the business quite some time, even though you don't look like it.
Yeah, I know it. I get that. I get that all the time. Yeah. No, we've been doing this 26 years now, and you know, recently with the market volatility that we've experienced in the last few weeks, really been pretty incredible. So I'm glad to be back in studio. We can talk about this. Hopefully,
no gray hairs, buddy.
Yeah, well, there's some coming in on the sides. I keep it cut short. What can I say? Yeah, you know, so a few months ago, we were sitting at the office and we noticed a number of things popping up on our radar screen in China. Their credit markets looked to be like they were having some trouble, I'll put it that way. I mean, we use terms like risk premiums and credit spreads and other things. These are risk indicators that give us an idea, you know, as to how healthy a credit market is in a particular country. And China was really, we saw some signals that didn't look too good to us. And so we kind of pulled back a little bit in Asia as a firm, but then a couple of weeks ago, or a few weeks ago, we saw China do something that they promised they would never do, which was really pretty shocking. I mean, they devalued their local yuan currency against the dollar. That was sort of like raising a red flag and saying, hey, we're in a state of emergency here, and it really unnerved institutional markets, and that started a rollover in the U.S. equity market, and we started to see real weakness a couple of weeks ago, and then of course all the volatility that we've recently experienced, and so yeah, our phones were ringing off the hook, and
imagine
we had media contacting us, the local news, all that stuff, and which is what always happens. And but you know, the thing I would say, and this was the message that we wanted to clearly articulate to everyone, was this is not a situation where you have a 2008 to 2009 type credit market scenario. Here in the U.S., throughout all of this volatility, we've seen the credit markets here locally, or overall the financial system, the health of the financial system is in pretty good shape. So nothing at all like what we saw 6-7 years ago. As a matter of fact, I would characterize this more as sort of a growth story, or a real worry, concern about global growth, and all of this was emanating out of China. And then we saw second quarter earnings in July with a lot of the really large U.S. multinational corporations, where you get commentary from CEOs saying, hey, you know what, our end markets are not that great right now. We want to sort of guide you down on your revenue expectations, Mr. Analyst, for the rest of the year. And when that happened, coincided with the yuan devaluation, that's when we saw this extreme volatility. So, you know, what I would like to say, I think about that in terms of, you know, what you should do to plan around this. You know, you really have two different types of investors. You have the retiree, who is really unfortunate for them because we're in a zero interest rate environment, and so they have had to they're compelled to get out of cash over the last few years, and they're doing things that maybe they normally wouldn't otherwise do from a risk threshold perspective. And that's things like owning stocks, owning tactical fixed income, high yield bonds, whether it's non-traded real estate investment trusts, business development corporations, and you know, they're starved for yield, starved for return, to try to generate some sort of income or return out of their retirement account to subsidize their lifestyle in retirement. And so, you know, when you see volatility like this, that's my great concern, is that you really need to monitor your portfolios very, very aggressively, be extremely proactive, because here's the reality: as a retiree, if you get a 10% correction in your underlying portfolio and you've withdrawn 5% throughout the year, you're down 15% in the account. So you've got a whole new sort of foundation in terms of principle.
Yeah, you got to try to build it up.
Yeah, and then that's what you're dealing with for the next year. So if you have a flat market the next year and you pull another 5, now you're down 20. So you have to really balance things up. You have to really be shrewd and understand risk in the marketplace. And again, be vigilant in terms of managing your balance sheet, managing your liquid assets, for those who are in retirement. For those who are not, Stay the course. You know, if you're building wealth for the long term and you've got money in the stock market as a part of your overall plan, then don't panic, don't
Grab
get out,
onto the
just
rail.
hang on
Yep.
and ride through the volatility. Sometimes for those non-retirees, it's a good opportunity to maybe say, okay, with all of this volatility, maybe I want to think about doing some minor shifting within my portfolio to either go up the quality curve, if you will, and look for high quality investments that just went on sale and got really, really cheap.
Right.
So you can dial up, you know, in the quality curve. So those are things that I would encourage everyone to do. But the key takeaway and the key message is, don't panic. This is not a credit crisis event. The financial system is strong, and we'll get through it.
Good. And the key, like we have always told our viewers, is the fact that everything you just went through, if you're trying to do it yourself, it's not going to work.
Right.
You need to have somebody that is doing this 24/7, which you people do.
When I was a young man, a wise man in my industry told me, he said, Brandt, never confuse brilliance on your part with a bull market. You know, and so the last few years has really sort of spoiled a lot of people into thinking, hey, we can just set it and forget it or own whatever and it's going to go up every single year. Well, you know, stock market returns are not risk-free.
No.
And it's days like we've had recently that remind us of that. There really is risk in the market. And so, yes, absolutely. Got to be proactive and stay on top of your situation.
Good. Thank you so much. And just remember this, grab a hold of that bar, hang on to it. We're now in the month of September. Things usually get a little bit different. Let's see what can happen as we move forward, and we'll be right back right after this.